Imagine a world where productivity and costs are in a constant tug of war, with the fate of the economy hanging in the balance. Welcome to the latest report from the U.S. Bureau of Labor Statistics, where non-farm business sector labor productivity has increased by 2.4% in the second quarter of 2025. But here's where it gets interesting. Output has risen by 3.7%, while hours worked have only increased by 1.3%. This begs the question, what's driving this surge in productivity? Is it the result of innovative technologies, or are companies simply finding ways to squeeze more out of their existing workforce? As we delve into the numbers, we find that unit labor costs in the non-farm business sector have increased by 1.6%, reflecting a 4.0% increase in hourly compensation. But what does this mean for the average worker? And how will it impact the overall economy? To understand this, let's take a step back and look at the bigger picture. The U.S. economy is a complex machine with many moving parts that can affect productivity and costs. For instance, the recent tariffs imposed by the U.S. government on its trading partners' exports have sparked a heated debate about their impact on the economy. Some argue that these tariffs will lead to higher prices and reduced demand, while others claim that they will help to level the playing field and boost domestic industries. And this is the part most people miss. The impact of these tariffs on productivity and costs is still unclear. As we navigate this complex landscape, it's essential to consider the perspectives of different stakeholders, from workers and businesses to policymakers and economists. For example, the Bank of England's governor, Andrew Bailey, has warned about the dangers of lowering interest rates too quickly, citing the risk of inflation and the need for gradual normalization of pay growth. But what about the role of technology in driving productivity? As automation and artificial intelligence continue to transform industries, we may see significant gains in productivity, but also potential job losses and disruptions to traditional employment models. So what's the verdict? Is the increase in productivity a sign of a healthy economy or a warning sign of underlying issues? The answer, much like the economy itself, is complex and multifaceted. As we move forward, it's crucial to consider the interplay between productivity, costs, and the broader economic landscape. But here's the question. What do you think? Do you believe that the current trends in productivity and costs are a cause for concern or a sign of a thriving economy? Share your thoughts in the comments below, and let's continue the conversation. As we explore this topic further, we may uncover more questions than answers, but one thing is certain. The relationship between productivity and costs is a critical component of the economy, and one that deserves our attention and scrutiny. So let's dive in and explore the intricacies of this complex issue and see where the discussion takes us.